Right. Good afternoon, everyone. Right. Let's start from where we stopped on last Saturday. Basically, we have been discussing about financial markets, and then again, I gave a brief introduction to fixed income securities, which will be, in fact, yeah, building on that today. Right. Then equity market. Yes, we have covered a lot on equity market as well. So last section of this area probably the foreign exchange market we will be covering shortly. So basically, in this course during these 3 weeks, I would say it is a brief introduction to portfolio management. But having said that, uh, I personally think that we cover the fundamentals of this area. So if anyone wants to take up a higher level course, thereafter you have some idea about what it is. So I think that is a good thing about this course. So I'm covering a very limited area. This is, I think, a diploma is for about 6 months. So basically, in other areas also you are covering the fundamentals. So it's you probably once you get your uh, qualification diploma in this, you have some uh, understanding of what it is, but you can definitely build on that, right? So this is something that I just wanted to tell you all very early stage. So like I said, we've covered the entire equity market also. Just straight away we'll go to foreign exchange market without taking much time. So we're a little behind the schedule. So I think when it comes to foreign exchange, I think being the superpower, so we have to uh, give some prominence to US dollar. So when you study the basic principles of foreign exchange, the terminology, the market, so we talk a lot of US dollar and how uh, dependent the foreign exchange market is also uh, on US dollar. So we'll basically study about some of the terminologies of foreign exchange. So some of the things that we try to uh, understand. So what is this foreign exchange currency exchange rate? So in each exchange rate there are pair of currencies. So buying and selling, we try to understand what it is. So each of these exchange rate actually specified to a date, right? We call it value date, and then two rates buying and selling I record. And so a pair of currencies is two currencies. One, for example, US dollar versus Sri Lankan rupees, right? Two rates in the sense buying and selling rates. So in addition to that, we try to understand what spot rate, forward rate, cash rate, term currency, base currency, direct quotes, indirect quotes. These are the fundamentals of foreign exchange, any course. So I think so. This is a good start for you all. Right. I think foreign exchange rates. So it's basically rate. Foreign exchange rate is it's the purchasing power, but the understanding is we try to understand the purchasing power of each of these countries, right? So so classic example is US dollar, US, and something that you can understand Sri Lankan rupees. We'll take two countries, US and Sri Lanka, and so exchange rate of US dollar to Sri Lankan rupees, you see what happened over the years. So currently our exchange rate, foreign exchange, US dollar Sri Lanka rupee rate is something like 200 rupees in the market, 203, but that is a government control exchange rate. But more than that, I think in the market, it is the US dollar is valued more than that. So we're actually selling at 230 40 rupees per dollar. So that's a currently going rate. So it is more than the government intervene the fixed rate. So that is something you need to understand, these two areas also, because being the regulator, controller, central bank always can decide on so what rate we are going to sell exchange foreign exchange currency. So as a result, they have taken a decision and communicated to all the commercial banks to sell at a particular rate, right? So in addition to that, now they are paying 10 rupees extra. So something 210 is with the extra 10 rupees that pay. 210 is the bank rate, but in the market it is selling at 230 or 240 rupees. So basically, so 230 or 200 rupees per US dollar, you know what is the more powerful currency. One US dollar, we are giving our 200 rupees, right? We are kind of weaker country when it comes to purchasing. That is something that you need to understand, right? If you go to a country like Indonesia, so their currency is rupiah, right? So it's rupiah is again, so for our rupee, they have to pay about 5,000, about three to 4,000 rupiah. So that's then in that case, when compared to Indonesia, Sri Lanka is relatively purchasing power of Sri Lankan rupees higher than the Indonesian rupiah, right? So two different cases. But here is Sri Lankan rupee to US dollar. I think it is obvious. I think US dollar is the much powerful currency, and they have higher level of purchasing power. So exchange rate is the parity. We try to compare the purchasing power between these two currencies. So if you are asked to define the exchange rate, is the way of measuring the purchasing power of two different countries, right? So in other words, exchange rate, okay, is a ratio of one unit price of a good of two different countries, right? Let me put it in a practical example again. So all of us have actually tasted McDonald's Mac, right? With the burger. So I'm not going to McDonald's for some time now, but I think the price of a Mac is currently about 1,000 rupees. Just assume it is 1,000 rupees, right? Same thing in the USA. So if you put into this exchange rate, the Mac is priced at five US dollars. So when you divide 1,000 rupees by 200, 5, right? So that's the exchange rate. Okay, then so unit price of a same good. Unit price of a same good. What is the same good? Is a Mac. We are taking the price of a Mac in terms of US dollars and Sri Lankan rupees. I told you Sri Lankan rupees, it's 1,000 rupees. So if you take the US dollar rate, it is $5. So that's again in a different way of explaining what is the exchange rate. It's a ratio between unit prices of the same good of two different countries. So it's another way of explaining what is the exchange rate, right? So this currency ratio of US dollar $1 to 200 rupees or something like that. So it is actually driven by the country's inflation rates and the interest rate. So you probably know our country, Sri Lanka's, a country with higher level of inflation rates. So when compared to US, it is relatively a developed, not relatively, as it's a developed country, their inflation rates also at a very low level. They manage their the economy really well when compared to countries like Sri Lanka and Pakistan and the countries like South Asian countries. Uh, so usually what happens is the country with higher inflation uh, depreciates against the country with lower inflation country, when compared to US dollar. US is relatively, they have a lower level of inflation when compared to Sri Lanka. As a result, Sri Lankan rupee gets depreciates. So that has been the case right throughout. I think in 1948, you must have heard our Sri Lankan US dollar actually the exchange rate was about 2 rupees, if I remember correct, right? One US dollar was 2 rupees then. So we have depreciated 100 times now, 200 rupees, right? So that's the difference. I think we had a fairly lengthy discussion of what the exchange rate and factors affecting exchange rate. So we now know one factor is the inflation rate, and the other main factor is the interest rate, because the interest rates and the inflation rates also go hand in hand. So it is very much influenced by exchange rates, are very much influenced by inflation rates and interest rates. So in addition to that, any countries, these are the common factors determines the exchange rate of any country, right? So any factor affecting interest rates affect the exchange rate. So then the second factor is expectation of interest rates. So if we expect so if our country's interest rates to go up in the future, definitely our currency also bound to depreciate in the future, right? Then the monetary policy. So early this year, monetary board of central bank decided to increase the policy rates. So what these policy rates and all we'll discuss in shortly. So I think they have increased the policy rate, giving the direction of the exchange rate also to depreciate further, right? So macroeconomic indicators like GDP growth. So if we have a very good growth rates, our currency can get stronger. But if it is not, our country getting weaker again and again. So then the current and capital account balances, the commodity prices, current and account, and because import export difference, right? So how much of goods are imported to country, trade deficit we call it, difference between the import and export difference, we call it the trade deficit. Usually we have a trade deficit, but since we have introduced this import ban, we to a greater extent managing this deficit, right? The speculation is uh, how we think about the future of if you again the expectation, something very much similar to expectation, speculation. We speculate the currency exchange rate to go up, right? uh, so if we speculate more, our currency gets depreciates, right? So and then the demand and supply for exchange rate. So higher the exports, kind of we have a very good supply of dollars, right? If you have a higher level of exports and higher the imports, there is a big demand for imports. Then again, demand and supply for foreign currency, again that is linked to trade surplus or trade deficit. So some of these factors are interrelated, but generally we can list it out, these factors as the factors that decides the exchange rate. Right. Hope I'm clear to you. So let me check chat box whether you have any questions. So if not, we can take it further and deep you can go deep into dive deep into exchange rates. So basically, these are the basic stuff. Any course in first couple of weeks try to cover. So you probably also happy that you know about it. As bankers, you should know this. So it's not about working in a bank. You should be able to, as a professional, for you to come out in life, you should know other areas in the banking, so that you'll be very competent banker. So let's move on to those other areas, right? Uh, so let me some of the terminology, right? We in exchange rate, two different codes. We call it direct codes and the indirect codes, right? Uh, Indirect codes, the direct codes. I think, like very beginning, I told how much US, because being the superpower for about over 100 years, they, most of these terminologies actually derived or produced or started discussing first in US. So they have a lot of control over the terminology that we use. So as a result, direct codes actually wherever any exchange rate, okay, uh, the base currency, wherever the base of the pair of currencies, two currencies, the base currencies, wherever US dollar is the base currency, we call it a direct code, right? Direct code whenever the base currency is US dollars. So all other cases, right? All other cases indirect codes, right? So when the base currency is not US dollar, so then we call those codes as indirect codes. So what you need to understand is there are two currencies. One, the base currency, we always compare 1 unit per 1 unit. What is uh, the price of the other country's currency, right? What is the rate? So we always try to peg to 1 unit currency. So when we compare any currency with regard to one US dollar, it could be Sri Lanka or maybe Great Britain pounds. So if it is for one US dollar, generally in general terms, now exchange rate is about 1.5 by 1.5 to 6. So 1 US dollar is equivalent to 1.6. Let's assume 1.6 sterling pounds. So we compare one base currency is US dollar. Then it is also a direct currency, direct code, right? So whenever or wherever the base currency is not US dollar, then we call it indirect code. So whenever we take the exchange rates of sterling pound to Sri Lankan rupees, it's an indirect code, right? So I think, if I remember correct, one sterling pound is equivalent to about 250 Sri Lankan rupees. So here the base currency is 1 unit of sterling pound. So it is not US dollar. So then we call those codes indirect codes. So whenever we compare 1 unit of US dollar as the base currency, then it is a direct code. So any other case, it's a indirect code, right? This is something that a terminology that you need to understand. So so pair of currencies, two different currencies, just to give kind of a understanding with some kind of a graphical illustration. So base currency, US dollar, here term currency. Two pair of I told pair of currencies. One is base currency. Yeah, we compare 1 unit base currency. The other currency is term currency, right? So whenever the base currency is US dollar, we call it direct code. So GBP, whenever the base currency is not US dollar, we call it indirect quote, right? So I think this will clear all your doubts if you had any previously. So currency pair direct quotes, right? So always there are two quotes, right? One is buying rate, or we call it again bid rate, and also US dollar selling rate, okay, or offer rate or ask rate. So the same thing, bid and buy, B started bid, so it's the same thing. So how much of when you buy $1, how much of rupees that you have to pay? So usually we do this comparison with regard to a bank, right? So banks, when they buy US dollar, how much of Sri Lankan rupees they pay? That's a buying rate, right? So when the bank is selling US dollars to maybe their customers or importers, when they are selling, so when importers need dollars, they need to buy it from banks, right? uh, Importer is buying, then the bank is selling, right? So that's a relationship. So the basically the foreign exchange is also a product for a bank. So it bank is trying to make profits, right? So always the selling rate is, I told you we have this discussion of buying and selling with regard to banks. So when the banks want to make profits, so bank is selling US dollars or any foreign exchange at a higher rate than the buying rate. So when they buy US dollars, so any foreign currency from, so they buy US dollars when exports come to Sri Lanka. They buy these US dollars and they sell Sri Lankan rupees. So exporters scenario, banks buy and sell Sri Lankan rupees. Importer scenario, banks sell US dollars and buy Sri Lankan rupees. I think you need to understand those two concepts really well, right? That is something that you need to keep in mind. Those are because based on that understanding only, so I can tell you that you understood this subject uh, really well or not. So if you don't understand, so let me know. I can explain it again. So once more, foreign exchange, bank also doing a business when dealing with the foreign exchange. So if it is US dollars, so banks get US dollars when exporters sell their earnings in US dollars to banks. So banks usually buying US dollars and selling Sri Lankan rupees, right? That's where the buying rate comes. So when importers need US dollars for importing purpose, banks sell US dollars, right? So selling rate is higher than the buying rate. So that's how banks make a profit out of foreign exchange transactions, right? In other words, we put it in some numbers, plug certain numbers, so for you to understand better. So unit of base currency in terms of unit of term currency, $1 US, Sri Lankan rupees 199.3, and GBP US dollar 1.6989. So indicates that number of term currency units against base currency unit, right? So always exchange rate says number of term currency units against one base currency, meaning one unit of base currency. Number of term currency units per base currency unit, one unit, right? So that's the meaning of currency pair, right? So so wherever when we deal with $1 US, general terms, $1 US is equivalent to 199.3. So when it comes to British sterling pound, it's about 1.689. This is what we discussed. I showed it to you a little while ago. So there are two rates, buying and selling rate. Example, US dollar to Sri Lankan rupees. So buying and selling rate, I told you selling rate is higher than the buying rate. So buying rate, we indicate the first buying rate 99.1, 99.25, 203.35 is the selling rate. So meaning banks buy a dollar and selling LKR 199.25 and sell a dollar buying LKR 203.35. So what we have explained previously, I think we were able to put it in writing here for you to understand the entire thing perfectly. So based on the, I think inflation rates and the inflation rates and the interest rates, we categorize the entire foreign exchange currencies in the world to two categories basically. So wherever the currency belongs to a economy which has a lower interest rates and lower inflation rates, we call those currencies as premium currencies because these are more valuable currencies. Everybody wants to keep their, put their hand in more valuable currencies like US dollar, sterling pound, euros, Australian dollars, or so those are some of the valuable currencies. And for these countries to have a valuable currency, they manage their economy, they have managed their inflation rates. So interest rates also very at a very low level. We call those currencies premium currency, right? Basically, it's decided by the level of inflation and the interest rate. So other currencies, the countries like Sri Lanka, Pakistan, right, Nepal. So our inflation rates are higher. So as a result, our currencies are called discount currencies, right? So these are the two areas that in a currency exchange rate market. So you frequently get to know. So so practically, where do we at bank level, at transaction level? So where, what are the instances where we deal with foreign exchange? So for an example, TT, telegraphic transfer for very small order. If you try to, maybe for an example, one person who actually buying and selling cellular phones, maybe China. So they deal with TT. So they send the TT foreign currency to whoever the exporter. And so in that scenario, we use foreign exchange rate. So if it is China, we are doing a transaction with China, we do it in Chinese yuan, right? That their currency yuan. But if it is for a small order of some other country, US dollar, we do transactions in US dollar. So TT, so we have to buy, so sell, the banks have to sell the US dollar. We usually take TT selling rates. So drafts, if anyone wants to send a US dollar draft, so then also we use this exchange rate. Export bill purchase, so can be when exporters send their uh, goods outside Sri Lanka, the counterparty or the importer send us their bills, so they can actually discount these bills and take sell these US dollars and get the foreign Sri Lankan rupees if they want. So that in that scenario also, when they sell their US dollars denominated export bills, so then also we use exchange rates. So more common scenario is currency notes. So whenever we go abroad, we take currency notes from bank, and then again we use exchange rates, right? So if you want to buy, we then again that's bank selling rate. We have to pay Sri Lankan rupees at bank selling rate and acquire US dollars. So these are the premium currencies. So this is just to give briefly. So what are the kind of premium currencies? US dollar, GBP, Euro, Japanese yen, and again discount currencies are Sri Lankan rupees, maybe Indian rupees, Pakistan rupees. Those are kind of currencies which is which are discount currencies. Uh, that ends come to the end of our basically the portfolio of understanding of various areas of financial markets, the equity markets, and the foreign exchange market. So just to give you for you to answer actually. Give you a question. If you can take 5 minutes and jot down answers. So for you, finally you need to understand this and put it in right in the exam. So just to make sure you understand what type of questions are actually posted to you in the exam. Give you an understanding. I actually put this question. If you can quickly take 5 minutes and jot down answer. So now it's 2, 3. So 2, 5, 2, 8. I'll try to come out with the discussion and give you an answer. So in the meanwhile, I expect all of you to take a piece of paper and give you a best shot and try to come out with a draft. Come out with the answer. So maybe a couple of points. So should be able to. So you can exactly know whether you understood the entire concept. So maybe very small area. This question is testing. So let's start. This is the question, right? I hope it is clear to you all. So able to jot down few points. I would like to see at least some of you put the 1 or 2 points in the chat box so that so I also understand whether you understood or not before we start the discussion, right? 1 or 2 at least for everyone. So there are 15, 17, maybe 15 people in this call or the class. Can 1 or 2 people put what are you the point 1 or 2 points that you came to your mind in the chat box, text, whatever. I'll give you 1 minute. No answers yet. The chat box. Is it difficult? It's the type of question that you can expect in the exam also, right? It's not the content that we learned in the class, but you need to understand and should be able to show you understanding, right? So that is what we are trying to test in the diploma level, right? It's not so what are the factors of foreign currency exchange rates? It's maybe one or two questions like that. So at this level, we try to test your understanding. Right. One person had put C. Right. Shifani says investing in stock market, the higher the risk we take, the higher the return. Yes, exactly. So that's the example. She's spot on. This is the example. So we can put it in writing in our answer as well. So at this level, maybe diploma level, even in banking, at not in the there are two levels now. Second level, so basically try to test your examiner is try to test your knowledge, not the knowledge level, understanding. So this is a question try to test your understanding, not the. So basically, first level, your many questions are actually try to test your knowledge. You can study and by heart and get through it. But second level, some people struggle because some people don't know how to uh, improve their understanding and approach or answer the questions set by the examiner. So yes, she has given the example. So question is effective bank management is essentially the effective bank risk management, right? The banks accepts risks to earn profit, but the risks and the profits are positively related. I think somebody else also answer. So let me check that as well. Yes. Two more people. Jasoda saying investing in bonds in long-term investment return. So we need to tell what is the return, what is the risk. Is it investing in bond high risk, high return, or low risk, low return? You need to, like Shifani said, stock market high risk, high return. You need to say we learned the other day also. We'll learn little bit detail in today. We need to put it in writing. Bank do many exchange rate activity the risk. So here again, exchange rate, you need to say whether you take high risk or low risk, or what is the return. You need to give some kind of a explanation on that high risk, high return. So I will straight away, try to come out with a method to answer this type of question. So uh, here in this type of a question, basically what you need to do is uh, briefly explain giving appropriate example why risk and profit positively correlated. So you can straight away give stock market, the investment they take higher risk and it gives higher return. That's an example. But before giving that example, you need to show your understanding. So this talks about uh, positive correlation, right? So last two words, positive correlation. So for you to get the full marks, so in addition to giving a couple of examples, maybe high risk, high return, you can give one example, low risk, low return, you can give another example. So example side, you cover that, right? So in addition to that, you must be able to, show you understanding. What is you basically understood by positive correlation? So what do you mean by uh, positive correlation? What is the meaning of positive correlation? So if you can put it right in, give someone showing you understanding on positive correlation and plus give two examples, you can get. So usually you get 5 marks for this type of question. You can get entire 5 marks, if not 4, right? So that's the maximum you can get. So a positive correlation is when there are two variables, right? So uh, taking risk is one variable and return is another variable. So a positive correlation is when one increases, the other one also increases, right? Uh, Negative correlation is when one increases, other one decreases, right? So investment risk return relationship is always a positive correlation. Higher the risk, higher the return. Like she said, when you invest in stocks, you take higher risks and you get higher returns as well, right? So similarly, if you invest in government securities, right, treasury bills and treasury bonds, you know it's a government guarantee, and you get a return anyway. So it is a credit risk. Credit risk is free, zero. So there is no risk you are taking at all, but you get a return. So that is low risk and zero risk for some return, right? So in between, there can be other investments as well. So the zero one extreme, you can say zero risk or low risk and low return for government securities, fixed income securities, and on the other side of the story you have high risk, high return. So that's example is stock exchange, but these both of these cases are positively related. When one goes up, the other one also goes. One goes down, so zero risk or lower risk, return is also low. So these are positive correlation. Other correlation is negative correlation. Also we call it inverse relationship. When the one goes up, the other one goes down. So we call that kind of a relationship inverse relationship as well. Negative correlation or inverse relationship, right? So that sums up, I think, last what we started last week. So if you have any questions, you can post, and otherwise you can start today's lesson straight away. Right. Shifan is asking what is cross currency rates. It is not covered here. Anyway, cross currency rate is, so when you have, so I give you exchange rate of Sri Lankan rupee to US dollar, right? So again, I can have a code for Sri Lankan rupees to, no, I can have the US dollar rate to sterling rate, right? So you can, so you probably can go to the example. Right? Similarly, here, so we have one US dollar to Sri Lankan rupees 199.30, and British pound or sterling pound to US dollar, it is 1.699989, right? So cross rate is, we can using this rate, so it is not directly give. You can calculate what is the exchange rate of one sterling pound to how much of one sterling pound in Sri Lankan rupees, right? But cross currency, using this cross currency, one cross currency is US dollar to Sri Lankan rupees, the other currency is British sterling pound to US dollar to sterling pound. So using these two currencies, we can calculate the Sri Lankan, how much of Sri Lankan rupees as an exchange rate for 1 sterling pound, right? So you can basically multiply 1.689 into 199.3. So that's the cross currency. Using cross currency, you can calculate that rate as well, right? So just to get some understanding, let's multiply 199 into 1.699. So if you use this rate, it's about 338, right? So I think normally the rate is about 290 odd. So I think we need to do some correction. Maybe sterling pound rate is not exactly 1.69, could be 1.4, something like that. Okay. So anyway, how you use these cross currencies to get another new currency rate is so that's what I explained. You can use two exchange rate and calculate another unknown exchange rate by using the cross currencies, right? So that's, hope it is clear to you as well. So let's start a new lesson. It's about money market and risk management concept, right? So let's start, right? Uh, so any person not seen the bank balance sheet, I just actually put it in this slide. What are the in a bank balance sheet? What we identify as assets and what we identify as liabilities. So in bank balance sheet, we identify loans, investment, fixed assets as uh, the assets. Basically, asset is something uh, in a business which generates income, right? So in banks, main income is generated by loans, right? So loan is an asset. So there can be other investments also. Maybe banks can invest foreign exchange to do buying and selling, right, to make a profit, or they can do investments in so it is also a regulator's requirement, investment in treasury bills and treasury bonds, so that gives a return, right, gives some interest income, right? Those are assets. Liabilities is something that banks owes the other parties, borrowings, right? Banks can take loans from outside parties. Deposits is also loan taken by the depositor, right? Uh, General public. So we have taken money from depositor. We owe that money to uh, the depositor. Retain profits and equity is part of the stock shareholders, right? We are liable to pay some return for these equity holders also. So basically, these are the areas, items in the balance sheet. So just to give you an understanding, this is the face of a balance sheet of a particular bank, right? So these are detailed balance sheet for you to understand. So let's see. So what are the items in a balance sheet on top? So on top we see cash and cash equivalents, balances with central banks, right? The placement with other banks, maybe deposits with other banks, securities purchase on resale agreement, right? Reverse repo with central bank. Uh, Derivative financial assets, finance through profit and loss. So then comes the loans and advances, right? Financial assets at amortized cost. So loans and advances. On top, we usually have the assets which has the highest level of liquidity, right? So any moment you can use that to you keep your liquidity level at a higher level, right? So as you go down in the assets, the liquidity is very going down, and so financial assets like loans, if whatever we invested in loans, we can't recover. We have to wait till customers repay. It comes very slowly, right? So when we go even further down, we have this leasehold properties and properties and things like that. If banks own a property where they have their own branches, that's a fixed asset, right? So you can't sell it and convert that to rupees and cash immediately. It takes a while. It takes time, right? So you as you go down the balance sheet in assets category, you get a higher level, lesser and lesser level of liquidity. So higher the on top, you have the assets with the highest level of liquidity. So when it comes to liabilities next, uh, so whatever you get due to banks, you have that, and again, uh, due to depositors, this is the highest uh, amount of liability category. So usually depositors is the highest value uh, liability item, and the 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 loans invested in customers is the highest uh, bank's point of view, highest investment in assets. So you have to balance that, right? So that's the way that we banks make profits. So you need to strike a very good balance between your deposits and assets to make good profits. So then after liabilities, you have equity. That's part of the shareholders. Stated capital, we now call it reserves, retained earnings, right? So then you have the total uh, liabilities with and equity. So that's why we have the balance sheet, and underneath that we have these contingent liabilities and commitments. The contingent liabilities and commitments, uh, with which banks make their other income. So contingent examples for contingent liabilities are bank guarantees, maybe the the bonds in the sense, not government bonds. So sometimes we have to in construction industry, we issue similar to bank guarantees, we give bonds to construction industry players, right? So those are bonds, we get fee income. So other than that, we have this LCs, letter of credits, and export bills. So all these part and parcel of this uh, non uh, I think contingent liabilities, off, we call it off balance sheet item, also not within the balance sheet, off balance sheet, but it is not interest bearing items. So items like assets like loans in interest bearing, but these items are fee income. So this is something that again, yes, banks pay, have some liability, but not something very straight away can be converted to cash, right? So just to give you some understanding about bank balance sheet, so how banks operate, and so money market in the operations. So bank, basically, if we discuss about treasury, operations of treasuries, these are the functions basically treasury does on day to day, on regular basis. Uh, so they how cash, and otherwise the cash inflows, cash coming into the bank. Uh, there are few ways. We call of interbank lending. So we discuss what are the interbank lending shortly. So we can so there can be, we lend to other banks, interbank money market. So we can recall it, ask for our money. So then in that scenario, we can get our money back, right? So interbank borrowings, right? So interbanks borrowings in the sense, we can borrow from the interbank money market. Then also we get cash inflow into to the bank, right? So LKR proceeds from foreign exchange. We have exchange for foreign currencies. We sell foreign currencies and get LKR. So in that scenario also we get Sri Lankan rupees into banking stream. So customer inward transfer. So our customers transfer funds from one account to our bank account. So in that scenario also we get money. Sale of securities could be equity. We have our investment portfolio. Maybe we have invested in shares in the stock market. We can sell them and then we also get money back. So maybe debentures. We can sell those debentures. Then also we get cash into our banking system. So this is what basically and day in and day out Treasury is managing. So to have a smooth cash flow and very healthy liquidity level in the bank. If we don't have regular cash flows, if we don't manage, then we are in trouble because when the depositors come and ask money, you won't be able to pay them back. So then it's an issue. So we'll have to have a very smooth uh, cash inflow and outflow. Manage both these areas in order to give comfort to our the depositors. So or lend our regulator. So the regulator also closely watching what our inflows and outflows. So we need to give them that comfort. So just the opposite of inflows, outflow. So repayment or in the bank. If we borrow something, we have if we pay back our borrowings, cash is going out of our money, our pockets, our bank, treasury. So that's the outflow. Interbank lending. So maybe one bank in the money market, they have a short. They are short in the short. So we probably give them a loan. So in that scenario, cash will go out of our stream. So that's again a cash out. So LKR payments of foreign exchange purchases, right? When we purchase foreign exchange, so we'll have to pay the Sri Lankan rupees going out of our pocket. So customer outward, when we make payments to outward transfers to our customers, it is going out of bank. And when you purchase securities, then the Sri Lankan rupees or LKR local currencies go out of this. So basically, as a bank, to maintain our liquidity level, we have to manage these two outflows and inflows. So that we need to predict how much of payments we are expected from our customers, from loans, how much of customer inwards, outwards. So maybe purchase of securities and things like that. Those are one of situations we can have a kind of an idea. But day-to-day basis, the transaction happens. We need to have a thorough idea using our data and predict accurately what our inflows and outflows. Then only we can manage our cash flows within ourselves. Otherwise, we can easily get into trouble. Right. So these are the we are going into details of reserve ratio. So these are some of the policy rate. One of the key policy rating of the central bank imposed reserve ratio. Reserve ratio is the ratio of central bank is expected. Bank, all the commercial banks are expected to deposit certain percentage of their deposits in the central bank, right? That is the ratio we call reserve ratio, right? So it is at the moment, it is 4%, right? Of the total deposits, banks have to keep 4% in the central bank. So this actually for safety purposes. So banks are expected to keep. So in difficult situation, we can take back some of this money to improve our liquidity. So what you need to remember is 4% is the reserve ratio. So how you calculate that? 4% is given below, right? From 1st to 15th, we take 1st to 15th of preceding month. So maybe last month, we take the first to 15th each day bank level. We get the data first, second, third, up to 15. What is the deposits banks have? We divide that by 15 and we get the average daily deposit at bank level, and we take 4%, and let's say average deposit 1 billion, and we take 4%. That's I think 40 billion. Then if we keep that 40 billion, so we take that from 1st to 15th of last month. Now in this month we keep that 40 billion. 1st to 15th we keep that 40 billion with the central bank. So that's the 4% of last month daily average deposit. We keep that from 1st to 15th of the next month. So that's how we actually calculate and practically implement that. So this is indirectly control the available liquidity at the bank level. And so these transactions, so whatever, so this 50 billion is actually transferred through our current account. So if there is an issue, like I said, we have to go to interbank money market, and if you have an issue, we can take money from interbank money market and deposit in the central bank. So for that, we use the current account we have with the central bank to do this transaction, right? So this is about reserve ratio, right? So money market, another very important tool in the money market is repo and the reverse repo, right? We'll go into details of repo and reverse repo also shortly. So the function of repo and reverse repo is, so when whenever the banking system, right, whenever there is shortfall in liquidity, right, central banks can actually inject. When there is a shortfall of cash in the system, central bank has the capability to inject cash into the money market, financial system. Similarly, when there is excess cash in the system, central bank has the ability to take that money from the system and keep it in the central bank. So for that, the tool that they use is the repo and reverse repo. So whenever there is excess money in the market, banks can deposit that money at the central bank at standing deposit facility rate. We have a very specific rate. We'll come back to it. That is currently 5.5, right? So when the banks have shortage, so then banks can take a loan from the central bank to improve their liquidity. That rate we call it standing lending facility rate. So that these are the two rates. By using these two rates, central bank actually balance the cash in the within the system. So when the deposit rates, standing deposit rates are attractive, banks try and keep their money in the bank, central bank, just to increase their interest income. So if it is attractive, they keep that money. So in that way, banks are encouraged to keep that money in the central bank. As a result, it is not in the financial system, right? So similarly, so banks, when they are struggling to make their day-to-day transaction, they are in their cash projections, like inflows and outflows are not very regular. So they can always go to the central bank and ask for a loan. And I think through this mechanism, using this standing facility rate and standing lending rate, central banks control the general interest rates of the country also. So that's I think all about the policy level decision making actually goes through the monetary board of the central bank. This is what exactly they do. They want to take money into the system, they increase the standing deposit rate, and if they want banks to discourage, their giving loans, so then again they actually increase the policy rate. So they are discouraged to, the banks are discouraged from lending. So these are the rates in nutshell. Policy rates, these are we call policy rate. Central bank standing deposit facility rate, that's the rate which banks, commercial bank, go and deposit in the central bank at 5.5%. And central bank, whenever commercial banks want, they can go to central bank, ask for short-term loans. That comes at 6.5%. General bank rate, maybe like very short-term. If the bank is very adverse situation, they can go to central bank, ask for short-term loans or something similar to what we give to our current account holders, temporary overdraft. Banks also, when they are very dire stray and they have some liquidity issues, they can go and ask central bank to ease out their liquidity issues, but it comes at a cost 8.5%. So that basically, so if you go very frequently, that will not good for the bank, will also the reputation. So whenever very frequently, if you go to intermoney market to go and ask for frequently, showing that you have some liquidity crunch, liquidity issue, so that does not reflect good on you. So, but anyway, so at any cost, banks take money to keep their liquidity level. Otherwise, they get into other issues. So, but if you frequently paid 8.5 to central bank, you are deteriorating, you are letting eating out to your profits, because 8.5 is very costly, right? So statutory reserve ratio we talk about 4%. Of that, 2% should be cash balance, notes and coins. So we need to, for bank transaction, we need to have 2% of the statutory ratio should be cash balance. So those are the basic money market ratios that you need to know as bankers. So some of the the practical things that is, I think, not very serious. Is all these money markets, the usually commercial banks and primary dealers take part, and usually they start very early. And so all these discussions, you saw these things in telephone conversations. We saw this in the video that we have showed it to you last week. And so then all this communication happens through Reuters dealing systems and Bloomberg and dealing systems. So the big transactions like to take place, that is done through RTGS, real-time gross settlement systems, right? So we briefly discuss about payment systems of the bank also today. So rates are basically driven by liquidity. So if the very good liquidity level, rates are down, low. So if liquidity is very crunchy, so then the rates will go up. So that's how. So basically market settle down around 10:30. That's how it operates. And so transactions through RTGS and messages are actually done through Swift messages, and CBSL current accounts are used, and so this transaction takes place between 10:30 and 4:30. And so then I will move on to some of the like try to go into details of some of the very unique money market instruments. So before that, I think just to refresh your memories, and I think it's better for us to go and revisit what we have, I think, studied last week, and give you some different flavor of the coupons, issuer, and investor, the rating agencies, before going into details of today's lesson. So I'll try to break the monotonous also. I'll have actually try to show you a video. So with that, I think we can basically give you some further understanding. Give me a second.
There are 5 quick trains in the fixed income security.
I think hope you can see the video. If not, to just at least either you say me louder or put it in the text box. I think I'm trying to play the video right now.
Module. This is the first one. Key features. In 7 minutes, you will be able to describe what is meant by the issuer, the principal, discount, premium, coupon, coupon frequency, credit rating, investment, and non-investment grade. Let's begin by looking at an example of a fixed income security. Here we have a corporation called Cable and Wireless. Way back in 1994, it needed to borrow about £200 million. Now, Cable and Wireless might have a problem approaching the local bank manager to borrow such an amount. An alternative to raising this amount of debt privately is to issue a bond. Similar to an issue of equity, the bond issue will involve a prospectus outlining the full terms and conditions of the issue. Investors can then tender for or take part in an auction process in order to buy some of the bonds. This initial market whereby the issuer, Cable and Wireless, raises the funds from the initial investors is called the primary market.
So Cable and Wireless raises about £200 million from investors. This bond is a 25-year bond. The investors will receive back the principal amount of their investment in 2019. The principal amount of this bond, also known as the par amount, is £200 million. This means that on the maturity date in 2019, the issuer will repay the bondholders £200 million.
Visible.
This may not be the amount that the issuer originally received.
Can you hear?
Sir,
See the video?
the video is not visible, sir.
All right, give me a second. How about now?
In the Securities module.
Can you all see the video now?
This is the first.
So we can see the email body,
Email body, not the video, right?
not the video. Yes.
Fine.
There are 5 quick trains in the fixed income securities module. This is the first one. Key features. In 7 minutes, you will be able to describe what is meant by the issuer, the principal, discount, premium, coupon, coupon frequency, credit rating, investment and non-investment grade. Let's begin by looking at an example of a fixed income security. Here we have a corporation called Cable and Wireless. Way back in 1994, it needed to borrow about £200 million. Now, Cable and Wireless might have a problem approaching the local bank manager to borrow such an amount. An alternative to raising this amount of debt privately is to issue a bond. Similar to an issue of equity, the bond issue will involve a prospectus outlining the full terms and conditions of the issue. Investors can then tender for or take part in an auction process in order to buy some of the bonds. This initial market whereby the issuer, Cable and Wireless, raises the funds from the initial investors is called the primary market.
So Cable and Wireless raises about £200 million from investors. This bond is a 25-year bond. The investors will receive back the principal amount of their investment in 2019. The principal amount of this bond, also known as the par amount, is £200 million. This means that on the maturity date in 2019, the issuer will repay the bondholders £200 million. This may or may not be the amount that the issuer originally received in 1994. The price investors paid for the bonds in 1994 depended on supply and demand at the time of the issue. The bonds may have been issued at a discount, in which case less than 200 million was raised, or they may have been issued at a premium, in which case more than 200 million was raised. So investors buy this bond in 1994 and receive back the principal in 2019. What happens in the meantime? The bondholders receive interest income from Cable and Wireless. This interest income is called a coupon. In the case of this particular bond, the rate of the coupon is 8.625%. So Cable and Wireless pays the bondholders 8.625% of £200 million. That is £17.25 million each year, every year, until 2019.
Some bonds, such as this Cable and Wireless bond, pay this coupon once a year. It gets paid on the anniversary of the maturity date, the 25th of March. Other bonds pay more frequently, perhaps twice a year or 4 times a year. This coupon frequency does not change throughout the life of the bond. Coupon frequency and its significance is dealt with in a later quick train. Let's see how some of the information on our cable and wireless bond is presented on Bloomberg. The DES function on Bloomberg gives a detailed description of a particular bond. Here we can see, amongst other things, the issuer, the maturity date, the principal amount, the coupon rate, and the coupon frequency. We can also see that the bonds were issued at a price less than 100, that is, at a discount.
And we can see credit ratings. Many, but not all, bond issues are given a credit rating. This is an assessment of the ability of the issuer to repay the debt. The main rating agencies are Standard & Poor's, Moody's, and Fitch. The S&P top-rated debt is AAA, and as the perceived creditworthiness of the particular issue deteriorates, this goes down, as can be seen here, to AA+, AA, AA-, single A+, and so on. Issues with a credit rating of BBB or above are considered investment grade. Those below are considered non-investment grade, often called high yield or junk. This particular bond issued by a corporation is a corporate bond. Bonds issued by national governments are called sovereign bonds. Bonds issued by states or cities are called municipal bonds. There are also bonds issued by supranational organizations, such as the European Investment Bank. And there are bonds, such as mortgage-backed securities, issued by special purpose entities.
What do we know so far? From the perspective of an investor, a fixed income security usually involves receiving the principal amount of the security from the issuer on the maturity date of the instrument. It also usually involves receiving interest income, a coupon, from the issuer at regular intervals until maturity. From the perspective of the issuer is a borrower and must pay the lenders, that is, the bondholders, interest and a return of principal. Remember, the bond we've looked at here in Quick Train 1 highlights some basic bond features. But there are many variations on what we've seen here. Some of the variations are considered in later quick trains.
Quick questions. Click on pause to give yourself time to answer. Identify the term being described. The entity that raises finance by selling fixed income securities. The issuer. The date upon which principal is finally paid to the investor. Maturity date. The interest amount paid to the investor. Coupon. The amount paid to the investor when a bond matures, also known as the principal. Par. An attempt at assessing the ability of a borrower to repay a debt. Credit rating. The minimum S&P rating that is considered investment grade. BBB minus.
You should now be able to describe what is meant by the issuer, the principal, discount, premium, coupon.
Hope it was clear to you. And let's get on with the balance. Right. So why I actually showed you this video. So in a while we started learn how to calculate the price of treasury bill and treasury bond. So at that point, this coupons, maturity dates, and issuer par value. So those things, very important. So if we have forgotten what we have learned last week, so just wanted to give you some kind of to refresh your minds so that you are ready in a while, right? So quickly, until such time, we quickly go through some of these other instruments which are used to improve the liquidity level of the bank, right? So basically, the basic method. So we little while ago looked at all the cash inflow streams and cash outflow streams, right? So depositors' money is one of the key way of taking money into the system, right? But entirely we can't depend on the depositors' money also for us to keep our liquidity. So whenever there is a depositor come and ask money, so we can't say we don't have money and things like that. But as a bank, we need to have established system. I think banks have, but just to give you understanding, so what is methods of improving the bank's liquidity level? What are the tools they use? So in addition to, you must be knowing that yes, we have deposits and all, so we have 100% relying on deposits to keep rolling our cash flows. But there are other sophisticated methods that banks currently using to improve their liquidity. So that's why banks perform or run operate at this level at this moment. Although there are a lot of ups and downs in the market, banks have very professional setup, professional teams, the specialists in the treasury who are masters of it. This is the reason why banks actually running smoothly when compared to governments, right? Governments, struggling. So you must have heard the what is the investment rating. Usually we investment rating is BBB and above. What is the rating Sri Lanka gets? So it is disappointing. So you heard about the sovereign bonds also. If you want, I can in a while explain what is Sri Lanka's crisis is all about also in a while. Just quickly, go through these slides and understand what are the alternatives ways of banks using to improve their liquidity. One way is interbank money market. Okay, so this is a interbank money market where so all the banks percent, right? They all come and exchange or take part. So there are banks in certain days they have positive cash flows. Some banks have negative cash flow, deficits and surpluses. So in that scenario, interbank money market, banks can, if they want money, can take money, right? So basically all the central bank, the brokers, unit trusts, the primary dealers, insurance companies, they are the players. So if any of these party needs money, they can ask for money. But if there is a liquidity, like I said earlier, if there is a liquidity crunch, you get, there is a tendency of quoting higher rates. But if there is smooth, you probably lucky enough to get very attractive rate from the money market, right? So like I said, but it is not a good practice for banks to frequently go to money markets to satisfy their liquidity requirements. In that case, it is not going to help the bank. It could tarnish the image of the bank also. So it shows clearly bank in trouble when it comes to liquidity, right? So this is a very this is a tool. Interbank money market is a tool for banks to take short-term funds, right? That is one. And another instrument is the commercial paper, right? So banks deals with in billions of money. So there can be situations bank need quick money. Probably they don't have time to negotiate a loan with another financial institution, or it is the amount is required amount is higher than what we can transact on day-to-day basis in the money market, or asking a loan from a central bank. So if and those alternatives also very costly, expensive. But commercial paper is another instrument through which banks can take money from very big institutions, like large conglomerates, like maybe John Keel's, maybe Haley's, that kind of big organization. If they have surplus cash, through a broker, quickly we can negotiate a commercial paper. So these repayment terms start in from 1 month to 1 year, and so they charge very nominal interest rate, 0.5 to 1%, above risk-free rate. If the treasury bill rate is about 5%, they charge about 5.5 to 6%, that kind of a thing. So and in certain situations, this, if the required amount is 5 billion, so they can transact it in a discounted, so not, they don't get entire 5 billion, maybe 5 billion 999 million something, and balance amount to compensate the interest. So in that scenario, we call it this commercial paper, traded at a issued on a discount basis, right? So if not, they charge interest, risk-free rate plus 0.50 at 0.5 of 1%. So the beauty of this instrument is, now John Cale's, this is a commercial paper, it's a legal document. So we just to as an evidence, we give the commercial paper in the written document agreement is given to the John Cales. If we take 5 billion rupees and they release the money which we wanted, if it is at a discount, a less amount, and if we charge interest rate, they charge the interest rate at maybe monthly or end of the period. So whatever the way, so the document is with now the commercial paper is with John Cales. So just in case they issued for 1 year, in between, so maybe John Cales also badly need money for a project, right? So immediately they need money. So what they can do is that commercial paper can be traded in the money market and take their money. Similarly, they can negotiate with another party, and the terms also. If there is a party willing and have money, they can take money and by doing a transaction, trading or selling that commercial paper to another party. So likewise, it can go from hand in hand. So that's the beauty of it, because that has a more liquidity, right? So this is, but in a way, for commercial bank, this is very much easier to raise money through commercial banks. But if we go for a maybe investment bank or to raise money, it is going to be very, very complicated, right? So very short term to solve short term liquidity issues. This is another good way or good solution. Another way of banks taking money to their system is also debentures, right? It's usually banks issue debentures, maybe 3 years, 5 years. So it's very much similar to stock market. So these debentures are issued at 10 rupee shares, right? So for this share, debenture amount, so 10 into, say, someone take 1 million shares, 10 million, right, worth of money. So the 10 million, they have an interest rate also, right? Debentures also has a interest rate. So that interest rate is, relatively higher than the market interest rate. So for if they keep interest rates attractive only, banks can attract money to their system. So, but so when compared to fixed deposit holder, so debenture holder, fixed deposit, if they in between, if you need money, you have to banks charge the penalty rate, right? You are penalized, right? But if it is if you invest in a debenture, you have like share in the market. So like what we have done with the commercial paper, you can sell that debenture stocks in the market and take your money back. So sometimes your price of that debenture can be little higher than what you bought. So then in that case, you make some profit also. But the important aspect is, this is a way the bank issue this debentures and take money into the system, right? So these debentures are issued on senior or subordinate to other liabilities. Senior or subordinate in the sense, so banks, senior means, so banks also have some securities with the central bank. So maybe treasury bills, treasury bonds. So senior in the sense, these debentures are secured by those securities, right? These securities which is held by the central bank. In that case, if bank go bankrupt, I think banks go bankrupt, debenture holder is bound to or expected to get the money back, right? But if it is subordinated to other liabilities, in the sense, if it is not secured, unsecured or subordinate, what happens is the debenture holder is not expected to get the money. So maybe, so in case of a bank bankruptcy, so banks first pay the depositors and their creditors first, and if there is anything left, only subordinated debenture holders get their money back. But if it is a senior debenture, so then definitely there is a security, because they are secured by government treasury bills or treasury bonds. They, at the time of liquidation, they are guaranteed to get their money back. So like I said, this can be traded in the stock market. So any moment, debenture holders can get their money back. So important aspect is, this is another way banks can improve their liquidity. So so another fixed income security type of fixed income security is asset-backed securities, right? So asset-backed securities, these people's leasing and credit card companies, right? Maybe even the banks issue credit cards. So people's leasing, like specialized leasing companies, so they need a lot of money for their to give leasing facilities, they need a lot of money. But for them, they also can raise money through deposit, but it is very competitive when compared to banks. Finance companies get fixed deposit, but a lesser amount, right? The bigger chunk of fixed deposits are held with the commercial banks, right? So yes, they can people's leasing company, central finance, they can get fixed deposits, they can mobilize deposit, not a bigger amount. But so how are they going to do their business? Because leasing business, they need a lot of money, so they can't to take loans from investment banks or commercial bank. They don't have very valuable fixed deposit securities also. So what they do for to have their liquidity at a higher level, what they do is, so all these leasing facilities, so they have a contract, right? So what they do is, so maybe let's say they have papers leasing have 100,000 leasing customers, so they 100,000 leasing contracts. So what they do is they keep these receivables of leasing contracts as a security with the commercial bank or the mainly with investment bank, and take money. So it is like, so we keep our property as a security and take housing loan. This companies like people's leasing, they as a security, they can't expect to have so much of fixed assets. No, they keep their asset is their asset is the leases. No, so the leasing contracts which generates income, right? These are their assets, biggest asset. They keep those assets with the investment bank. They take their money to keep their business rolling over. So that's how they actually keep their liquidity at a higher level. This is common to maybe hire purchase, leases, credit card, receivables, and account receivable. I think we next week we'll do a small case study. So just remember, so this mortgage-backed securities is the one of the main reasons the banks in US, investment banks US in 2008 2009 period resulted this so-called financial crisis, right? So it's a very good investment tool to have a good liquidity, but if you don't manage it well, so we can run into various issues in the financial, not only in the financial institutions. On those financial institutions, entire systems can get into trouble. So what is important here is, here, asset-backed security system, banks keep their assets as a security. Assets is the assets generating their income. Could be leasehold assets, leases, or could be mortgage-backed securities. So anything, they can keep it in the investment bank, take their money to roll their business over. So this is another very important tool banks and investment bank use for take their money. So last but not the least, there are two fixed income instruments. So far, in fact, we'll starting from interbank money market, commercial papers, debentures, asset-backed securities, all these through this banks can take money, right? So treasury bills is not something that banks take money, but this is a tool to excess liquidity. Banks need to, in addition to so part of their assets investment, compulsorily they have to make in the central bank investments in treasury bills and treasury bonds. It is at least 20%. That is the statutory liquid ratio of a bank. 20% of their assets should be invested in treasury bills and treasury bonds. For that purpose, we learn what is treasury bills and treasury bonds. So these are instruments, investment instruments Usually actually issued in 10,000 numbers. So these investment treasury bills in particular. So credit risk is free, government guaranteed instrument, security. These are issued 3, 6, and 12 months short-term instrument, right? For government projects for short-term cash requirement, they issue treasury bills, right? This either can be issued in with a discount or face value less than the market price or at the market price 100 rupees or so. This also can be freely tradable in the secondary market. So treasury bills usually have zero coupons, and it can be traded in the money market for given prices on day-to-day basis. It is important area is credit risk, short-term, 3, 6, 12 months period. For short-term government money requirements, they issue. So banks can invest in it. And so again, 20% of their investment, the funds, assets should be invested in the treasury bills. Similarly, treasury bonds, very much similar. Difference is these are long-term, right? So all other terms are similar to treasury bills. One important difference is these are long-term. Treasury bill 3, 6, 12 months. These are issued from 2 years to 30 years. Again, these are issued for government money requirement. So 2 to 30 years, right? So those are the bonds. So and also like we in that video also we saw the coupons can be can be issued paid in quarterly basis, semi-annual basis, or annual basis. Again, this is also freely tradable in the market, right? So this is about treasury bonds, right? And so a repurchase agreement. So we learned about repurchase agreement, repo, right? So standing, I think deposit rates, applicable rate. Actually, this is a standing lending rate, right? So let me explain that standing lending rate and standing deposit rates, which is applicable to repurchase agreement and reverse repurchase agreement. So, so what is repurchase agreement, right? So we talk about we know standing deposit rate is 5.5, standing lending rate is 6.5. So repurchase agreement, what happens is the banks usually sell the security. So maybe it could be treasury bond or treasury bills to central bank with an agreement to buy it back, right? So for any sales transaction, so what do you think happens? The bank, so let's say, forgetting about selling securities or treasury bills or treasury bonds. So in a normal day-to-day scenario, let's say I operate a grocery shop. When I sell my grocery items to a customer, what happens? I sell my goods and I take money into my system, my drawer, right? Drawer. So I'll take money. So in that sense, in any sales transaction, money coming into the system, right? So money coming into system is in bank terms borrowing, right? So what happens in repurchase agreement? So go one by one, stepwise, one step at a time. Bank sells the security with an agreement to buy it back, right? So banks, what is important is bank sells the security. So money comes into the system. So when the security is sold, it is sold at a specific to buy it back on a specific future date and with a specific interest rate. But the important aspect is selling, right? So when sells, money coming into the system, bank effectively borrow money from this operation, right? So banks borrow from the central bank. Then applicable rate is standing lending rate. Repurchase rate agreement is standing lending rate. Applicable rate is 6.5, right? Just the opposite, the other way. Reverse repurchase agreement is opposite of that. The bank buys a security. Whenever maybe grocery, I buy my stocks, right? So for me to sell to my customers in the area, I'll buy my stocks. Maybe could be rice stocks, could be sugar stocks or whatever, right? So when I buy, I actually pay my suppliers, right? So money going out of the system, my bank, right? So then again we'll come back to our security transaction. The bank buys a security, so money goes out. So this transaction, purchase transaction, happens with an agreement to sell it back on a specific date, on a specific rate, price. But through this system, banks, giving money out effectively. Banks lend money from this operation. So lends money in the sense, banks keep that money in the central bank, deposit money, right? So central bank gets money. So that's a standing deposit rate. That's 5.5%, right? So we need to know what is repurchase rate, repo rate, what is reverse repurchase agreement. So what's the relationship with that to standing deposit rate and standing lending rate. So this is something that you need to understand when it comes to repurchase agreement and reverse repurchase agreement. So either way, you can use this tool either to take money to bank or borrow, or to keep your surplus money with to earn some interest income. So this is the way that I in the beginning. So central bank use this reverse repurchase and repurchase agreement to control the money supply in the market, and in that way bank rates also. So these are interlinked. So if you ask a question, what are the ways that central bank controls money supply, you can use this reverse repurchase agreement and reverse repurchase agreement to explain that also in detail, for you to get the full, show your understanding and get your full 5 marks, right? So I think for that you need to understand this concept. All right. So let's see whether you have any questions so far. Not so far, right? So we'll take a break. So have some refreshments, and come back. We've been studying this for about 2 years, 2 hours. So we'll take about 15 to 20 minutes. So we'll meet up at 3:50, and so while you taking the break, you answer this question also, like the early question. You jot down some answers, come back, so that we can discuss the answer. So when we meet up at 3:50, right? See you. So let's start with the question quickly. We'll do this question. Give me a second. The first, in day-to-day business operations, banks have to undertake treasury operations to ensure that net flow of funds is efficiently managed. Explain how a bank uses each of the following markets for its treasury operations, right? So how the banks use these tools to improve their liquidity. So treasury operations in the sense liquidity, right? So call money straight off. So call money is also we call them intermoney market bank. So interbank money market. So this is a short-term arrangement. So bank can go for the to the interbank money market if there is any shortage. They can fulfill their short-term liquidity issues. So settlement should take place very in short-term time period. So they have to pay relatively higher interest rate. So I think these are actually knowledge-based questions, not understanding. So call money market, you have to say what you know about call money market. So interbank money market and call money market is the same, right? So this is banks go to call money market or interbank money market to meet their short-term liquidity requirements, funds for short-term liquidity requirements, and they need to settle those loans very quickly in short term, and they have to pay higher interest rates for that as well. So, and the next question, interbank foreign exchange market. So we and when I explain how the local currency, so interbank money market operates. Similarly, interbank foreign exchange market also present, right? It is in operation. But in addition to local banks and for these, foreign exchange market, so like we saw in the last video, different, primary dealers in the different parts of the country also can take part, right? Foreign exchange, so nothing to do with our Sri Lankan counterparts, looking for short or, excess money in local currency. We need players who have foreign exchange, so that we have to open this to not only actually interbank foreign exchange. You can say the partners, there can be commercial banks in Sri Lanka and outside primary dealers, and also foreign exchange agents or dealers in the foreign exchange market are present here. And so all these transactions also happen through a platform, a Bloomberg, or some kind of a settlement system also take place in payment using payment system. So so when whoever wants the foreign currency in big volumes, they can quote for it. So depending on the liquidity, the exchange rate also can go up or down, right? So that's something that you have to remember. So few things to remember. So interbank, you have to say by definition, who are the partners, local partners, commercial banks, and foreign exchange dealers, primary dealers who are present. So whoever wants, then they can quote and ask for, with the depending on the liquidity, the rates decided by the liquidity, you can take money, and these are operated through brokers or payment platforms, right? Systems like for them to take money, right? So central banks repo and reverse repo window. So central banks repo and reverse repo window. So central banks will have to reverse repurchase agreement and reverse repurchase agreement. You have to explain in terms of central bank. So this actually done with respect to a bank. The bank sells the security, right? So we'll have to put this into perspective by replacing this bank with the central bank, right? So when the central bank sells security, they actually so they then the opposite of that, no? So bank effectively borrow. This is the lending rate, standing lending rate, and similarly, reverse repurchase agreement when the central banks. So the banks buy. So effectively, bank lend. So when it comes to central banks, the other way around. So when the central bank buys security, it's standing deposit rate. So that's how you have to interpret. So banks lend it with regard to central bank, it's the opposite. And then when the central bank buys security, the central bank effectively accept deposit at the deposit rates. So reverse repurchase agreement, that's the opposite. So that is also done. And last, repo market in government securities. Repo market basically they deal with reverse repurchase agreement and repurchase agreement. So so that's it's number 3 and 4 very much similar. So repo market, government securities, that's with regard to third one with regard to central bank. Repo market in government securities. So we can explain the government scenario, bank scenario. When bank sells, what happens? When banks buy security, what happens? So I think that's how we should answer the question. So it is everything we've learned. So just to put it in writing, just there is no testing your understanding what you have studied little while ago. So it is tested. It is knowledge testing, completely knowledge what you have understood. So maybe central bank window, you'll have to think a bit because that's the opposite of what we learned. So and repo is just the same, right? So other than that, it's straight from the note. Right. So with that, like I promised in the morning, in the afternoon. So now we are moving on to learn to calculate the price of treasury bill and treasury bond. So these are the two main things that we try to do next hour. I think very important area. It's predominantly calculations, but you need to understand upfront for you to do the calculation well. But there are few practice questions also, so then you can do those questions and understand. I in an exam, I usually throw one from either from just simple calculation, very much similar to what we learned today, and usually how price calculation of a treasury bill or treasury bond. So that's part of the question usually, but there are 100% at times I'll give essay type questions also. Sometimes I'll give a small sum also, so that you keep that in mind and try to listen and understand how we are going to do it. Right, let's go. Any questions before we go to calculations? No? Right. Right. Okay, so how so we have a standard equation for treasury bill price calculation. P equals 100 divided by 1 plus within 1 plus within brackets y is the yield, right, to maturity, and n is the number of days to maturity. This is the equation. So you can plug in numbers and you can do the calculation. But for that, I think it is very much important to understand how this formula is derived. So let's try to understand that first, right? Number one, interest. So basically, so it is very simple. Even for fixed deposit interest calculation, you do this very much similar to this. Interest is calculated. Basically, you must say what is the principal amount. If it is 1 million, so what is the interest rate? Yield is actually here replaced by interest rate, right? So in fixed deposit we say interest rate, but in bonds and treasury bill we call it yield, right? So let's say it's 8%. So now in the formula itself we have denominator 100. So basically we substitute the full number 8, right? Not 0.08, 8 because 100 is down now, so 8. So yield is there, number of days is the so interest calculation. So if you are given 10% for 1 year, 360 days, 65 days. If it is for 6 months, we divide by 2. Otherwise, 365 is here, we multiply by 182 days, very much, whatever, right? So that's how we calculate the normal interest of a fixed deposit. But so here, treasury bills and treasury bonds, there is very important concept that we learned in video also. The principal, the plus interest, we say it is the face value, and in treasury bills it is equal to 100 because there is zero coupon now. So principal plus interest in treasury bill, we call it face value equals 100. So with this, now we have one formula for interest, which is actually how we calculate interest for a fixed deposit. In the first formula, interest, we have one that now here also we have interest. We can in normal O-level mathematics, we so one side we have interest. Now if we take interest onto one side, and so now the interest is equal to face value minus, because principal go to the other side, it becomes minus, right? So face value minus principal, right? So we know earlier formula, we know that face value is 100. So we substitute face value with 100, and so interest equal to the price per 100 is the principal, right? So now the interest is equal 100 minus price per 100, and the earlier equations, principal and yield, number days, and 100 into 365, that part we can both sides equal. So ultimately you do interchange certain sections. Ultimately, the final equation for treasury bill calculation is P equals 100 divided by within bracket 1 plus within bracket Y into N divided by 364 into 100. And that's the equation. You have to believe me. So if you do the correct, you follow the correct mathematical solving, you see this is the solution. This is the formula you get, right? So if you remember this, it is important. But if you can understand and do the derive it on your own, that's good. But basically, this is how we do it. Interest, you normally for interest calculation, how do you do it? So principal into yield and number of days into 3 divided by 160 divided by 65, 365. So similarly, interest principal is plus interest is face value is equal 100. So interest we can face value is 100. So price is the same as price per 100. Price per 100 is the principal, right? So when you solve these mathematical equations, you get the final formula P equals to this one. So P is the investment price per 100, the price, and the N is number of days to maturity. Number of days to maturity. Treasury bills can get mature within 3 months, can be 6 months. There are 3, 6, 12, mature 3, 6, 12 months. So these are short-term instrument. And yield to maturity of the N, Y is the yield to maturity, yield of a treasury bill. So it is given in certain sums. So with that, let's start doing these calculations, sums. So there are a couple of sums. So when you complete these sums, and you should be able to, I think there are 4 sums. I think so next the treasury bill bonds. So once you do this 4 sums, I think you become a master of treasury bill price calculation. So we'll straight away understand the formula and try and substitute the numbers into this formula. But need to understand what is yield, what is the number of days to maturity, and what happens if the situation changes, and things like that. You need to understand, right? So the first sum, the current market rates are indicated below for use quoted in the secondary market. Secondary market rates are given in the here. Where there are no rates quoted for an exact number of dates, you may assume the closest given period interest rate. So if there is no close number of days in the sum, you can you go by the closest given period interest rate, right? So 3 months, 6 months, 12 months interest rates are given. So they count 1M is 31 days, 2M is 60 days, 3M is 91 days, 6M is 182 days, 12M is 364 days. But you can do 365 you can't divide, but 365 182, so you have to take the 364 and divide by 2 to get the answer. Otherwise unnecessarily you are complicating things. So if it is 364, you put 182, right? Take 182. So this is the first question. A bank has invested in a treasury bill with the original maturity of 6 months at 7.5 per annum. What was his investment value per 100? Due to the liquidity constraints, the bank wishes to exit the investment after 91 days, which is today, right? So what is the profit or loss per 100 of the bank if it sells today, right? So I'll give you 5 minutes, right? Clock starts now. Try to substitute numbers and get an answer. So with 5 minutes time, we'll start work out or solving these sums. So let's start. Time starts. Are you able to get the answer? 100 of the bank what sells today. What is the profit or loss per 100 of the bank if it sells today? What do you think? Is it should be a profit or a loss? What is the relationship between the yield and the interest rate? The price and the interest rate? Profit. Ruanti says profit. So what is the relationship we learned the other day? The price and the interest rate? Positive relationship or negative relationship? When the price goes up, when the interest rates goes up, price or the yield comes down, right? Negative, inverse relationship, right? So since 7.5 is the rate, when liquidity constraint, what happened 91 days, what's the interest rate? Whether it is the interest rate that we take less than 7.5 or higher than more than 7.5. So if it is less than 7.5, the selling price is going to be higher. So then it should be a profit. So let's say, I think profit, yes. Ruanti says profit. So yes, profit. So what then? Let's see what is the profit. What is the calculation? So 1.875. Let's see, right? So those who could not get the correct answer. Let me explain how to. P is the P is what we are trying to find in the first case, and when the original what we try to calculate the original price, right? P is equal 100, right? So then you have to put everything as the denominator under that. So within brackets 100 divided by within bracket 1 plus, right? 1 plus. What is the y now we are putting within bracket? 1 plus within bracket. We have to put the number. You shouldn't put the 100 here. 7.5. 7.5, not the percentage. You put 7.5, right? The 7.5. N is the number of days. So what is the number of days? 6 months. I told get the closest number of days. 300 here, 182 days, right? 182 days. 6 months, 182 days. That entire thing is divided by 364 and into 100. So next step, the 100. When you simplify, so basically you get 100 divided by 1.0375. 100 divided by 1.0375. So in that you get the price 96.3855. 96.3855. Right. So similarly, you can now question says, due to the liquidity constraints, the bank wishes to exit this investment after 91 days, which is today, 91 days, right? So another 3 months to go, right? What is the profit? So let's see now. So how are you going to do that? So 91 days. So 3 months. Now the rate is 6.65. 3 months. First line 3.3. Interest rate is 6.65. Now we substitute that. Not 7.5. 6.65. So other the 100 divided by, okay, 1 plus, now within bracket 6.65. Now 90 days more no, to maturity. 91 days divided by 364 divided by 364 into 100. So finally answer we get 100 divided by 1.016625, and the new price is 98.3647. 98.3647. Right. So let's see whether the given profit is correct or wrong. 98.3647 minus earlier price 96.3855. 3855. So 3855. 96.3855. My answer is 1.9792. Now 1.9792. Right? So maybe simple arithmetic error here and there, rounding off. So otherwise, your profit is correct and should be there. Right. Similarly, go to the next one. A customer has bought a 3M month ago at 20%. He wishes to realize the profit and loss. Tells today. So similar thing. So those who could not answer the first question, I think should be able to answer this one. Very much similar. So just to practice, you get it right. I hope you can get it right. So I'll give you another 5 minutes for you to work it out. So we'll come back with the answer shortly. So let's start. Can anyone put the answer, profit or loss, in the chat text? Yes, you have taken the same interest rate. That's where you went wrong. So can someone put the answer in the chat? If you get it right, you have a kind of a sense of achievement. So I encourage you to put that in the chat. What's the profit or loss? Is it a profit or loss? 20%. Now what's the interest rate? You can logically think it is a profit or loss. So when you do the calculation also, you will realize if it is a profit or loss. So both should be, logically. Now the 20% is the rate. What is the interest rate? So whether it is going to be a profit or loss, you can decide there itself. So when you do the sum also, you get the right answer. If the original price is less than the price you get later, so you get a profit, otherwise loss. So give 1 minute. Can someone put your answers in the chat? I really encourage. No? So let's start. So in the meanwhile, I hope at least one put the answers in the chat. Right. So let's start. Same thing. You put now 20% now. 100 divided by, so original price is 20%, right? Yield is 20%. The number of days to maturity, 90 days, right? So you put that, plug in those numbers. 100 divided by 1 plus below the division mark, 1 plus within brackets 20 is the 20 full number we put, and 90 divided by 364 into 100. So 91 or 91 days, 364. So it's 4. So the answer, so you get is 100 divided by 1.05, that is 95.2380 is the price, right? So let's see what happens then. He wishes to realize the proceeds of his TB. What is the net profit per 100 of the bank sells? Bought 3M TB a month ago. Now it's 1 month gone, right? So 2 months to maturity. But so at the time of taking that, so that 3 months to maturity. Now it has about 2 months to maturity, right? Let's see whether we have a price. So 2 months tenor, it's not there. So we have to, so if there is no, it says take the closest given period interest rates, no, so we have 3 months. So again, we have to contend with 6.65, right? For the second step. So you have to put again 100 divided by 1 plus within brackets 6.65, right? This time around you can put 31 62, no, or 31, yes, 62, and so 364, 31 days, no, 62 days, majority you have 62 days, no, so 1 month gone, it says, and 364 divided by 100. So you probably can take 60 on the numerator and the 360 for simplification purposes. So 90 divided by, 60 divided by 360, again 6. So how I calculate my answer I think second step, it is 1 divided by 1 plus 0, 1, 0, 8. 1 divided by 1 plus 0, 1, 0, 8. And 1 plus 100 divided by 1.0108. 100 divided by 1.0108. New price is 98.9355. My answer is 98.9355. So again, profit. So you can deduct 98.9355 and 952380, right? So, but relatively big amount. To 8.9355, about 3.7, 3.6975, right? So that's the answer. Good. So hope you get it, got it. And so when you do this sum, I think if someone say the second step, if you took again 6.65 divided by the same thing, like, similarly 90, and if you take number of days to maturity 90, 91, if you take 91 also, we can't say so much, we can't find fault with you, because you take you don't have the approximate number of days, you have the 91 days, no? So in that case you can assume that you have the maturity number of days to maturity also 90. So logically, if you can put it in writing, your assumption, you can get the full marks. But either way is possible and correct, right? So if you do get into this treasury bill calculations, there are masters, and so then these simple things can be very serious, right? So next, a bank buys a treasury bill with 178 days to maturity. What is the price per 100 he pays? Right, give it a try. Right, give it a try. So let's start. Can we see the answer? Right. So a bank buys a treasury bill with 178 days to maturity. What is the price per 100 he pays, right? 178 days, right? So, so for this investor, so whoever bought this, he has to hold till about 100 treasury bill 178 days to maturity. Now it's 4 days, right? Treasury bill banks with 108 days to bank, right? So with fourth day only he bought this, right? So the 4 days interest is does not the first 4 days interest actually does not belong to this investor. He bought on the 4th day now, so we'll have to calculate the full the price, and we'll have to take that 4 days interest. So we have a concept called dirty price and clean price, so we'll learn about that also. Before that, since you do this, once you work out this example, you should be able to understand that concept really well. Okay, so let's work out this example. So here the 100 divided by, so let's say what is the interest rate of 6 months? Interest is 6 months, 6.7, right? 6.7, right? 6.7. So 182 days divided by 364 and into 100. So you have the 100 divided by 1.0335. So the answer is 96.7585, right? 96.7585. So now 4 days interest does not belong to this person. So we'll have to take that take that out from that pricing. So that 6.7 into 4 days out of 182. 6.7 for him to earn 6.7, he has to hold for entire 182 days now. So he bought this first 4 days. So 6.7 into 4 divided by 182. So then you have the 4 days interest. It is 0.1472. 0.1472. So the final answer, the answer is 96.7585. You need to subtract that 0.1472. So the final answer, $96.7585 deduct 0.1472. So answer is 96.113. 96.113 is the answer. Right. So one last question from, I would say, treasury bills, before moving on to Treasury bonds. One last question. Question 4. I give 2 minutes, so it is. I think it's easy. You need to understand the basic fundamentals for you to answer this. Very simple. If you understood this, understood the concept, you will get the answer in a minute. So I'll give you 2 minutes. Someone is asking, what is the final answer of question 3? 96.6113. 96.6113. So you should know what is the formula for face value. Well, face value is equal to what? You get it right, you get the answer right. You don't get it, you will not get the answer right. Right? So let's move on. 2 minutes gone. So a customer has 10 million to invest. So if anyone got the answer, put in the chat box. Can cherish when I announce the answer. Let's see. So 10 million is the face value. So what is the face value? Let's see. Go to the first thing. So face value is, let's see, face value is principal plus interest is equal to face value. What is the principal here? Principal here in this question, principal is 10 million, right? Then you have to calculate the interest to get the price or face value end of 1 year. So what is how do you calculate the interest? 1 year, 6.95. So 6.95, 10 million, either 695, right? So the answer is 10.695 million. 10.695 million. So that's the answer. Face value equals principal plus interest. Principal is 10 million. So then you have to calculate the annual interest. You have to 12 months now. 12 months, 6.95 is the interest rate. So you keep it for the entire period. So the 10 million into 6.95 is 695,000. So the answer is 10.695 million. That's the answer. I think you got close to it. You might you didn't get the right formula. That's you only completed the interest component, I guess, right? So That's the mistake, I guess. Hari. Nilushi Uruguay 10.695. Good. So hope now you are masters of doing treasury bills calculations. So I'm also happy since a couple of you got right answers. So next we will move on to do the bond price. Just before that, I think I put this slide little, so not the place where I really wanted to. So this number 3, you have calculated the 178 after 4 days. You buy a treasury bill and you keep it 172 days. You take that interest off. So this is the concept. Explain the clean and dirty price as well, right? So when you buy a treasury bill, so before the maturity date, so up until you hold that treasury bill, you own the interest, right? But if you sell it, you don't get the interest, right? You need to, but that interest is actually owed to the original owner, right? So that's the reason why we have to take that interest out. So for an example, that sum, so we take 182 days, 4th day investor bought the treasury bill and he kept until the maturity date, but he has taken for us to get the right pricing, clean pricing, we have taken that 4 days interest, right? So you can have the price including that interest component. If that price includes the interest, we call it that price is a dirty price. But if you take that accrued interest out, the 4 days interest we have taken out, so when you take that out interest, then we call the clean price, right? So in fact, we have calculated in the sum the clean price, right? That's the difference between clean price and the dirty price. So if a transaction happens in between, original owner owns the interest of that treasury bill. So for you to clean that pricing, to get the right pricing, you need to take that original owner's interest accrued component to get the right pricing. So with that accrued interest, it is price, including the accrued interest, we call dirty price. If you take it out, it is the clean price. So I think it is better to understand that concept here itself. So now let's move on to understand how we calculate, how we going to determine the price of a bond. We know we have mastered how to calculate the price of the treasury bill. Now we move on to treasury bond. The difference between treasury bill and treasury bond is treasury bills 3, 6 and 12 months short term. Treasury bonds are more than 2, so it will go up to 30 years. So that's the difference. So this is the main reason why we have learned to calculate the present value, of any project or investment, because we use the same concept to calculate the price of a bond also. So in that video that we watched today, the price of a bond is equal to all the coupons we get, maybe every quarter or semi-quarterly, we get the price coupon interest component, we call coupon. So C is the coupon. So price of the bond is equal to C divided by 1R. So present value of first coupon, then the second coupon, we get the present value of second coupon, third coupon, so on will go on till we get the final coupon. And so on top of that, end of the maturity period, we get the in addition to coupon, we get the face value or the principal amount also. So we get the last final year, we calculate, we get both coupon and the face value or the par or the principal also. So when we get the present value of all these cash flows, we finally get the when we added it up, we get the price of the bond. So let's see in this calculation, how do you get it? Right? Example, assume a treasury bond with a coupon rate of 11% per annum, payable semi-annually. Every 6 months, the coupon is paid. Coupon is 11% every 6 months. So what is the coupon that you are getting? What is the coupon you are getting? Every 6 months, what is the amount? 5.5, right? So so you can put 5 cash flows, right? So like in this formula, you put 5 cash flows. So one is 6 months, 12 months, 18 months, 24 months. You can have 2 cash flows on 24th months, right? So altogether, you have 5 cash flows, right? 6 months, 12 months, 18 months, 24th month, because now the sum says 2018 to 20, no? 2018 to 20. So you get one coupon on 2018 July and 2018 December, and 2019 July, 2019 January, and 2019 you get 2019 December. 2019 December you get 2, one coupon 5.5 and the final the full 100 rupees also you get, right? So how do you calculate the present value of 6 month? 5 point. What is the discounting rate? So discounting rate is market yield. If the market yield is 12%, we get the discounting factor as 12%, right? So since we get every 6 months, we take the 12% is the per annum rate. No, for every 6 months we take 6%, right? So let's do the calculation. The first 6 months, 5 point first cash flow, P is equal to first 6 months cash flow 5.5 divided by 1 plus 0.06 to the power 1. First cash flow to the power 1, right? 12 months cash flow 5.5 divided by within brackets 1 plus 0.06 to the power 2, right? Then the third cash flow 18 months 5.5 divided by 1 plus 0.06 to the power 3. Right? Then the 24, there are 2 cash flows. One is coupon and the final one is the principal. Coupon 5.5 divided by 1 plus 0.06 to the power 4. So then the final cash flow 100 divided by 1 plus 0.06 to the power 4. 6% is 0.06. That's how you get the 0.06. The present value of first cash flow 5.1887. 5.1887 plus second cash flow 4.8950. 4.8950. 4.8950. Third cash flow 4.6179. 4.6179. Third cash flow, fourth cash flow 4.3565. Right, 4.3565. The final cash flow 79.2094. 2094. The price of a bond, final answer is 98.2675. 98.2675. That's the final answer. So usually in the class we do it this sum in the maybe whiteboard, but since I do this lecture from home, we don't have that facility. But anyway, I'll next week with the notes, I'll send you the full answer. Okay, do the full answer and send it across so that you have the calculation and the full answer for you to understand it further, right? So don't worry, I'll do this sum in a white A4 sheet and I'll send it across, right? Right. So that's it. Hope you understood. If you have any questions with regard to bond price calculation, so let me know so that I can explain it further. Anyway, I'll send you the full answer of the calculations and logic in a very separately, so you'll understand it better. But I think so. This is all about bond price calculation is the present value of all cash flows. Two cash flows, no. One is coupon, so what we get every 6 months, and the final on maturity date we get the coupon plus the face value 100 rupees. So we get every cash flow. End of every 6 months. So coupon is 5.5, 1 year 11. So every 6 months 5.5. That's a half. And so every 6 months we have that cash flow and we get the present value. So discounting factor, the discounting factor is 12%, but since we have take the present value of every 6 months, we take the 12% is the per annum yield. We take the 6 months yield. So that is 6%. 6%, we take 6% as our discounting factor, right? That's how we calculate. So when we get all the cash flows and add it up, so that's the present value of all the cash flows equal to the price of a bond. So we discuss clean and dirty price. So I think payment systems. So briefly, I'll run through this couple of slides on payment systems so that you will know what it is, because the payment systems are important, not because of anything. This fixed income securities and treasury bills, treasury bonds, these calculations, I think some of these complicated treasury bills, RTGS and securities, scripted security system, settlement system are the modes of payment systems. But SWIFT, kind of a more than payment systems, messaging system, STIPS, SWIFT is very common payment system that So I think you will know this by now since you all work. SWIFT is So this definition it's more than Society for Worldwide Interbank Financial Communication for all international trade transactions. So this kind of payment platforms. The main messaging system, communication system we use is SWIFT. So other than that, we use very at a lesser amount to using this messaging system. We use this to settle nostro accounts also. Nostro accounts, what nostro accounts, it will be taught you in a while, right? So SLIPS, Sri Lanka Interbank Payment System. So again, this is used to make less than rupees 5 million payments. So for you to, this is not a real-time system. So if you want to do small value transaction less than 5 million, could be salaries, dividend, or anything of that sort. So basically salaries of big companies, corporates are paid through SIPS transactions. So big, even the teacher salary through education system, education department, and the government, big factories, SLIPs are the ones to transfer salaries, right? So that is available through all the commercial bank. So SEFT is again it's a real time. So SLIPs is it's a for you to effect a transaction, you need to do transaction within the date before 10:30. So if not, it is effected on the following day. But SEFT is it's a more real-time transaction. It is getting updated real-time. So Lanka Pay is the one who is operating, managing this. So 24/7, 365 days available. So most of the people to pay with their credit cards out of other banks, they use SEFT. Also for small value transaction, you can use this. Right. So scriptless security settlement system is so this fixed deposits and all, that is the investment that you all and me and normal people, general public, that is the security. They have no FD certificate, right? So so similarly, when banks do their transaction investments in treasury bills, treasury bonds, these are billions of investment. But so they also need to have some kind of a system. So they can't do for FD certificate, we can have it. These are big value transaction electronically take place. It is very not practical to do paper transaction. So so this transaction happens online and on secured platforms. So maybe we use RTGS and SWIFT, RTGS for payment and SWIFT for communication. So these transactions actually takes place between central bank and commercial banks, and these securities also electronically deposited. So maybe each and every commercial bank has get the password and user name and password for their accounts. So once the transaction takes place, investment takes place, so in their web maybe area, so these securities are deposited so in a secured manner. So that's scriptless. We don't use papers, is what we call it, scriptless securities settlement system. So this is applicable for investment in treasury bills and treasury bonds between commercial banks and the central bank. So very much similar to treasury FDs, but these securities when not takes place on paper basis, online with the web, there is password security network. So in this, the owners, commercial banks, investor can go and log into this and see whether their investment electronically deposited or not. So if not, they can communicate and get things right. So that is the scriptless security system. So then the final thing for today. So let's try to understand nostro and vostro account. So so this is actually foreign currency transaction between local banks and foreign banks to implement that. We have this two types of accounts, nostro and vostro accounts. Nostro means our, vostro means yours, right? Nostro accounts are in foreign currency. We, for maybe our LC transactions and all, maybe maybe exporters, for to make exporters, our exporters payments, maybe foreign banks have their foreign currencies in Sri Lanka, Sri Lankan banks. So foreign currencies in Sri Lankan banks, that is your currency, your money in our accounts, that is nostro account, right? So nostro is ours, right? And nostro accounts are in foreign currency because, so yes, let me clarify that, clear that nostro is for our imports to take place in foreign currency. We keep foreign currencies in foreign countries, right? For example, so there is a vehicle importer in Japan. So we, our maybe Bank of Ceylon, in the nostro account in Japanese bank, that's the nostro account. Nostro accounts, foreign currency. We keep foreign currency in foreign bank, right? So we nostro accounts in foreign currency. So in I think in Japanese bank, we can't keep local currency. No point having local currency, no. So we keep the Japanese yen. So nostro account is in foreign currency. Vostro account is LKR, right? So your money. So Japanese money, we keep it in Sri Lanka. So we keep in Sri Lanka to do the local transaction. So Japan keep Sri Lankan rupees in vostro account. So in Sri Lanka, we keep Japanese banks money in Sri Lankan rupees. So for them to have this transaction, so mirror transactions, we need this nostro and vostro account. So definitely for international transaction to take place, so both banks need to have this nostro and vostro accounts to do their foreign currency transaction. So in Sri Lanka, for them to do Sri Lankan rupee transaction, they have their Sri Lankan rupee account. For us to do a foreign currency transaction in overseas, we have our foreign currency accounts in overseas. So these are the two types of account that you need to understand, which is used for vostro and nostro account. So I think with that, we'll stop here for today's. So next week we'll catch you from. We'll basically cover risk management and also so few more areas, and Basel. So risk management, another big area. So Basel 1, 2, 3 is the evolution, and do like I said, I will do a case study also for covering entire everything. Like to cover everything, we'll do a case study also. So let's meet up next week. So okay, that's it from me. So stay safe and meet up next week. If you have any questions, I'll stay here a couple of minutes. If you have questions, you can post your questions in the chat box. So let me answer today, or if not, I'll answer next week. Bye-bye.